Question. Jonathan Garner is Chief Asia and Emerging Markets Equity Strategist at Morgan Stanley. Jonathan, it's always a pleasure having you with us here. Thank you very much for joining us here on CNBC-TV18. So exactly that question, Jonathan. How much more selling, according to you?
Well, I do think we need to unpack this a little bit. The Indian market has been outperforming other EM quite dramatically in the last 3 or 4 years, and particularly outperforming China. And so what's happening is the weight of India in the EM index has actually been going up. And with the domestic bid very strong, valuations are relatively elevated. I wouldn't say they're extreme, but they're relatively elevated. And so what you're seeing actually is that the selling that foreigners are doing is just simply about that maintaining a quite large holding in India into a market that has been performing well. It's not some kind of problem that's going on here. It's actually a problem of success. And if we're right, our target for Sensex is 93,000. We're overweight the market. We're well above consensus on earnings growth. We expect foreigners to be very engaged in the Indian market this year. Over time, it's on its way to being the largest market in EM, and that means global investors are going to pay a lot more attention to India than they have in the past. And we see that a lot, being asked to arrange the first investor trips for global investors who really haven't looked at India historically. Historically, it's obviously been large within the EM bucket, but not for global investors. So it's quite a complicated situation that's unfolding.
So just to complete that point, and you look at this data very closely, so India's weight in MSCI Asia ex Japan is about just under 20%. FII ownership of India is now, I mean, there's a significant underweight, right? Relative to that 19.8, I think should be closer to 16%, Jonathan? I mean, what's the number now?
It's actually quite close to benchmark weight, but I think the reason that you're so aware of this, let's say, and people in India are aware of it, is that if you go back a decade ago, global EM investors were double weighted India. Double weighted. In other words, they realized that India was about to do very well, which is what we've seen. So this is this selling into strength story that I'm trying to get across to you within the EM investor group. But what has yet to take place, and we're so excited about, is truly global investors. Now these stocks are so large. We think about names like Reliance Industries or ICICI Bank, those two like mega caps, names we tend to like, they stand a chance of finding their way into global portfolios, which is a much, much larger superset, the entire global equities universe. And if you think about the US, that's ballpark, let's say 75% of all country world index, India's knocking on the door of around 2% now at a global level. Okay, so 2% of global equities. Once it gets to 3 or 4%, you can't ignore it anymore as a global investor.
Jonathan, of course, we read your notes and, of course, what Rhythm puts out here. And it really stands out as the most bullish voice on India right now, around where a lot of people are still circumspect despite the correction that we've seen. What do you think will turn, what will get that FPI interest back? Because they've just been rushing to the exit door, not checking anything. Are valuations still the biggest sort of impediment? Is it growth? When earnings revive, is that when you expect the buying to return?
Yeah, again, I wouldn't describe it as rushing to the exit door at all. I mean, if you look, for example, at market that performed very poorly, that's also a large EM market last year, Korea, the Indian market dramatically outperformed the Korean market last year. So you have to look at the totality of the situation, but to try to be looking forward here, what's important, I think, is that GDP growth is over 6%. We're forecasting 6.3% and then 6.5% this year and next, the year ending March and then the following year. That inflation remains moderate, a little over 4%. The interest rates, we get 2 rate cuts in our view, and that we get this kind of compounding of earnings at 15 to 20% per annum in rupee, which the market is able to do way above earnings growth everywhere else. And as that happens, India will continue to rise in the EM index, in the global equities indices. It'll continue to outperform. And the domestic bid is going to remain strong. And as I've said, at the margin, we're going to get a different type of investor in India, the truly global investor, rather than just the dedicated EM investor.
The earnings, Jonathan, that's what really stands out, because you folks have remained with the earnings projections being rock steady, like you said, 15 to 20% compounding earnings. A lot of people here, domestic sort of, money managers also are kind of questioning that, at least in the near term. So do you see this whole debate around a slowdown in India? I mean, how do you view it from your standpoint?
We're well aware of that and have written extensively on it. And we think it's a 2 to 3 quarter phenomenon. If we're wrong, if it's a 2 to 3 year phenomenon and earnings growth falls away substantially, then our call on the market will be wrong. But we don't think we are. So our colleague Ridham and then Upasana, who's our economist, fairly sure that they've identified the cyclical factors behind the downturn late last year. And, next up is, of course, the budget, where we expect the primary deficit essentially to be set around 0. And I do think that with the strength of the US dollar and the uncertainty over the Trump administration, that will gradually resolve itself. And as it does, I think it'll be dramatically in India's favor relative to some of the other markets we cover, most notably China. India has a lot of optionality in the Trump administration, which some other large EM geographies lack.
All right. Hi, Jonathan. Good morning. And, very encouraging to hear about a different kind of global investor coming into India, because as of now, the flows that come into India, more than 90% comes via the emerging market flows. But if you get a dedicated India flow, that'll be extremely encouraging. So we'll, look forward to that. But Jonathan, you gave us your upside target on the Sensex. I think that's close to around 15%, 18% away from current levels post the recent correction. On the downside, what do you think? At worst case, do you expect the markets to pull back maybe 10% from here at worst?
Well, we always publish bull, base, bear targets. I don't have the bear case right in front of me at the moment, but I would say that you could expect in a scenario where, for example, the S&P 500 enters into a bear market, some kind of early US recession, then you would get that kind of decline and maybe even larger than that. But I would say that at the moment, we're quite confident in the base case forecast that we have. I mean, bear in mind the backup in yields in the US is to some extent because nominal GDP growth remains very strong in the US. And though the Indian market is not as correlated with the US as in the past, ultimately, all markets have some degree of correlation to the US market.
Okay, all right, got that. Jonathan, I also wanted to ask you about earnings. Since you briefly spoke about that, we have tech numbers that have started trickling in there. And, besides the earnings reactions, the stock price reactions, the broad outlook is that things are getting better for tech. Your call on tech from here on, they've already seen a good run, valuation-wise, not very, very cheap, but at least you have some visibility on growth out there.
Yeah, so again, this is an interesting point. So whereas we're overweight India, for example, we're underweight Korea and Taiwan. So in Korea and Taiwan, tech means tech hardware, semiconductors. And there you've shifted from what we call the AI enabler or infrastructure rollout phase to what's now the adopter phase. And in the adopter phase, India is really quite advantaged versus those tech enabler infrastructure build. And so the kind of way that the corporate sector will be using AI lends itself to a lot of the kind of software services names doing well this year. So yeah, India would fit into that theme.
Jonathan, slightly pulling back a little bit, right? Bringing in the new incoming sort of president and the implications of that. You guys at Morgan Stanley over the years have published a fair bit about how we're moving to a multipolar world, etc. Yes. For an economy like India, I mean, we export very little to the US. Services, of course, aside. Import, in terms of from the US. So in that sense, we're kind of insulated, all this tariff talk, etc. Not completely. There will be some effects, second order, third order. But on the external side, does India, is 2025 to you looking a lot more adversarial? Or you think one should kind of keep that aside?
Yeah, we've made Multipolar World yet again a key theme for the year at Morgan Stanley, and you are going to see a slew of tariff and non-tariff actions, and that's going to be an issue for the more trade-dependent and US-exposed markets in Asia. We actually have a theme of liking domestic demand in places like India and Southeast Asia that are more like ring-fenced from that and more influenced by underlying domestic economic growth. And so that's an advantage. However, all that said, one other aspect of multipolar world dynamics is that corporates are relocating manufacturing out of China, and India's benefiting from that. and private equity and portfolio equities, but particularly private equity flows, are much more diversified than they used to be. And there is a boom in private equity interest in Japan and also in India. And so actually within the multipolar world framework, we often make the point that India is probably the most advantaged geography, the way that things are panning out between the US and China in particular.
Okay, all right. Just quickly, final word. We're approaching the budget. You are extremely optimistic on the economy and the markets here, Jonathan. What are you expecting from the RBI over the course of the next couple of months? And would you want to see anything more decisive by the government? Your budget expectations or recommendations for India?
Well, to some extent, monetary policy tightened, arguably, from the mid-year last year. We think some gradual easing is appropriate, but obviously that depends on the inflation outlook. And then on the budget side, we'll see, but there's been a very big focus on capital expenditure and infrastructure delivery. Maybe there's some opportunity to loosen elsewhere. We are in a cyclical slowdown in India, but India has plenty of firepower on the monetary and fiscal side to lean into that cyclical slowdown. So it's not something to be concerned about.
Jonathan, we'll leave it there for now. Thank you very much for joining us here
Thank you.
on CNBC TV 18. Great conversation as always, and we'll touch base again soon.